The automatic contribution had already processed before the first cup of coffee was finished. It showed up the same way it had for months, a line item on the payroll portal that no longer required attention. The number was higher now. It had been adjusted at the start of the year, moved from a percentage that felt comfortable to the federal maximum allowed for employee contributions. The confirmation email came and went without ceremony. By mid February, the paychecks were smaller in a way that wasn't immediately alarming. Nothing had broken. The mortgage cleared, utilities posted on schedule. Insurance drafts followed their usual rhythm. The grocery spending fluctuated, but not dramatically. It looked manageable on paper. The decision to increase the 401k contribution had not been impulsive. It had followed a promotion, a base salary increase that felt overdue after years of steady performance reviews. The raise wasn't extravagant. It moved annual compensation into a bracket that carried different expectations: higher withholding, larger benefit deductions, more formal retirement projections during annual HR meetings. The company's retirement match remained the same percentage, but the ceiling felt within reach for the first time. The adjustment had been described internally as responsible. There was no lifestyle inflation, no new car, no kitchen remodel. The home, purchased 7 years earlier with a fixed rate mortgage, still held its original appliances. Property taxes had climbed, but gradually. Homeowners insurance rose more noticeably, though it remained within tolerable limits. The house was stable. What changed wasn't visible in a single month. It was the accumulation of narrower margins. In March, an annual car insurance premium posted at the same time as a quarterly water bill. The credit card balance rose slightly higher than usual before the next paycheck arrived. It was paid off, as always. But the gap between charge and payoff felt tighter. The difference was subtle enough to ignore. By April, withholding adjustments reflected the higher retirement contribution more clearly. Federal and state taxes recalibrated around the increased deferral. Take-home pay shrank in a way that required attention, not panic. There was no emergency. The emergency fund sat untouched in a high-yield savings account. 6 months of fixed expenses calculated conservatively. Mortgage principal and interest, property tax escrow, insurance, utilities, groceries, minimum transportation costs. The retirement account balance, on the other hand, began to move with greater momentum. Each pay period showed a larger deposit. Employer match compounded on top. Quarterly statements arrived with percentages that looked steady. The long-term projections generated by the plan administrator showed a future income replacement ratio that felt reassuring. At home, cash flow told a different story. Summer brought predictable expenses, school-related costs, travel to visit family, routine medical copays. The household operated without debt beyond the mortgage. But cash left more quickly than it arrived. Credit cards remained tools, not liabilities. Yet, their presence became more constant in the monthly reconciliation process. There was no regret attached to the higher 401k contribution. It aligned with every financial principle that had been internalized over a decade of working adulthood. Contribute early, contribute consistently. Use tax-advantaged accounts. Capture the full employer match. Maximize when possible. What had not been fully anticipated was how the shift would feel across an entire year rather than a single pay cycle. By late summer, discretionary spending had narrowed almost automatically. Dining out reduced itself without discussion. Subscription services were reviewed, some quietly cancelled. Not as a dramatic correction, but as a natural consequence of watching checking account balances hover closer to the baseline threshold that felt safe. The baseline had always been psychological, as much as mathematical. A certain five-figure number in the checking account signaled stability. It meant no scrambling before automatic drafts. It meant optional purchases didn't require timing around paydays. With the increased retirement contribution, that buffer line was approached more frequently, even if it was rarely crossed. The retirement account, however, was expanding steadily. Market fluctuations came and went. Some months erased gains, others restored them. The contributions continued regardless. There was a quiet satisfaction in knowing the annual IRS limit would be reached before December ended. In October, open enrollment arrived. Health insurance premiums ticked upward for the following year. Flexible spending elections were reconsidered. The higher 401k contribution remained unchanged. Reducing it felt like reversing progress. There was a moment during a routine budget review in late fall when the cumulative effect became visible. Not dramatic, not destabilizing, just clear. The household's net worth had increased meaningfully over the year, largely driven by retirement contributions and modest home equity appreciation. Yet, the liquidity position had tightened. Cash reserves had not been depleted, but they had not grown. Every additional dollar earned from the promotion had been redirected toward tax deferred retirement savings. The raise had not translated into increased flexibility. It had translated into deferred security. December closed the books on the year. The final pay stub showed the 401k contribution cap reached exactly as planned. The employer mesh total displayed cleanly in the retirement portal. The tax deferred income reduced taxable wages, softening the federal liability slightly. The W-2 would reflect the strategic shift. In January, when annual statements arrived, the retirement account balance crossed a milestone that would have taken several additional years under the previous contribution rate. The compounding effect was no longer theoretical. It was visible in actual dollar terms. At the same time, property taxes increased again. Insurance premiums adjusted upward for auto and home. Groceries reflected broader inflation. Utility costs fluctuated with seasonal extremes. None of it was catastrophic. All of it was persistent. The household had become more asset heavy and cash light. The change did not alter daily routines. Work continued. Bills were paid. The mortgage amortization schedule progressed as expected. Principal reduction inched forward with each payment. The home remained stable, a fixed rate anchor in an otherwise shifting economic environment. But the margin for spontaneous spending narrowed. A last minute flight for a family event required more deliberate planning. Home maintenance projects were staggered instead of bundled. The checking account was monitored more frequently, not out of fear, but awareness. There was an unspoken trade embedded in the decision to max out the 401k. The trade was between present liquidity and future stability. It had always existed conceptually. Now it existed in the daily rhythm of account balances. The second year of maximum contributions felt less abrupt. Adjustments made during the first year had settled into habit. Discretionary spending remained contained. The emergency fund stayed intact. No new debt was introduced. The retirement account continued to grow, though markets introduced volatility. Some quarters delivered negative returns that temporarily erased months of contributions. The automatic payroll deferral did not change. It persisted through market downturns and recoveries alike. At midlife, the realization was not that maximizing retirement savings was wrong. It was that the emotional comfort associated with higher income had shifted locations. Instead of appearing in the checking account, it appeared in a long-term investment account that could not be accessed without penalty. The promotion had increased gross pay. The 401k decision had redirected it entirely. Lifestyle remained largely unchanged from the previous year, except for a quieter spending pattern and closer attention to monthly cash flow. Over time, the household's financial identity began to lean toward long term accumulation rather than short term flexibility. The balance sheet strengthened. The income statement felt tighter. There were months when the retirement account experienced meaningful growth due to favorable market conditions. The account balance would rise by amounts that exceeded annual discretionary spending. The contrast was noticeable, wealth increasing on paper while daily cash availability remained measured. By the third year, the pattern felt embedded. The annual contribution limit increased slightly due to IRS adjustments. The payroll system updated automatically. The maximum was recalculated. The higher number was absorbed into the existing structure without much discussion. The checking account no longer carried excess. It carried adequacy. The emergency fund remained separate, intentionally untouched. It existed for job loss, medical emergencies, or major repairs. It was not used to smooth routine fluctuations. That role belonged to disciplined spending. Colleagues occasionally discussed retirement contributions during performance review season. Some contributed enough to capture the employer match. Others increased contributions gradually. Few consistently reached the annual maximum. The distinction was rarely visible externally. It showed up quietly in account balances and tax forms. The household's tax profile evolved alongside the higher contributions. Adjusted gross income reflected the deferrals. Marginal tax exposure softened slightly. Year-end refunds or liabilities remained moderate, predictable. The most significant change was psychological. Income growth no longer translated into visible lifestyle upgrades. It translated into accelerated long-term savings. The gap between gross earnings and usable cash widened. Over several years, the compounding effect became substantial. The retirement account crossed thresholds that altered long-term projections meaningfully. Financial advisors' calculators, used occasionally during quiet evenings, displayed retirement income scenarios that felt more durable. Meanwhile, daily financial life maintained its measured pace. The mortgage payment remained constant. Property taxes edged upward annually. Insurance premiums adjusted. Healthcare costs fluctuated. Child-related expenses evolved with age. The decision to maximize the 401k had not created hardship. It had created constraint. A deliberate, ongoing constraint that prioritized decades ahead over immediate expansion. There were no dramatic consequences, no crisis, no windfall. Just a steady redirection of income away from present liquidity toward future security. At midlife, with retirement still more than a decade away, the realization settled quietly. The promotion years earlier had effectively been converted into long-term retirement capital. The lifestyle plateaued. The balance sheet advanced. The checking account at the end of each month reflected precision. Enough for obligations. Enough for modest discretionary spending. Rarely excess. The retirement account reflected accumulation that would not be touched for many years. The house stood unchanged on its lot. The mortgage balance declined predictably. Equity grew slowly. The retirement account grew more rapidly, fueled by consistent maximum contributions. Nothing about the decision felt dramatic in hindsight. It felt procedural. Yet, its cumulative effect reshaped the household's financial texture. Income once visible in monthly cash flow now existed primarily as a deferred claim on the future. Each January, the contribution percentage remained at the maximum allowable level. The payroll deduction processed before the first cup of coffee was finished. The line item appeared, steady and unremarkable. The household moved forward with narrower margins and stronger long term reserves. The trade remained in place, embedded in every paycheck.